Hello, everyone, and welcome to the NASDAQ Dorsey Wright Monday video. Today is Monday, June 8th, and I'm Eric McArdle. Joining me today is Will Gibson. And Will, I don't know about you, but I am spending this wonderful day on my front porch trying to get some work done and enjoy this work from home environment while we still can. How was your weekend? Everything good?
It was great. Yes, we're also really enjoying the weather. Warm weather felt long overdue here in Virginia, so no complaints at all from that front.
Excellent. And it still feels like spring here. I know summer's right around the corner, and with that, we get the Virginia humidity, so I won't wish that too quickly. But, that said, Will, as we start to heat up with the weather, the market is also heating up, and, there's been no shortage of action here as we have presented to you all through our research over the past few weeks and really over the past maybe month or two. But, starting out with the often referenced S&P 500 index, looking at our large cap constituents, we have continued strength on the chart of the 20-point chart, which is going to be a little bit more of an intermediate view rather than the default view. And we're looking at the S&P 500 with Friday's action continue to move past resistance on a second consecutive buy signal to a reading of 3,200 on the chart. So just a continuation of strength there. We saw this scale for the index reverse back to a positive trend on June 2nd, but really a lot of strength for large cap domestic equities continuing into the month of June. And, so far, so good for equity investors at this point, almost back to break even on the year. Now, with that, Will, we've also seen some levels of overbought readings start to creep back on up. What are we seeing on that front?
Yeah, Eric, that's right. And I'll say while the rebound has been, quite frankly, a relief for many, those conversations concerning the overbought status of the market are certainly beginning to circulate, and perhaps justifiably so. As we do here, we're looking at the weekly overbought oversold reading for the S&P 500 index located at the upper right-hand side of the chart. And this is reading 87% as of Friday's close. And this 87% is actually the highest reading we've seen since January 17th. Now, just to backtrack shortly, just a quick reminder that to reach this value, we're taking 10 weeks of price data and putting all that information along with a volatility calculation into a statistical bell curve formula to give us an intermediate term trading band. So when a security approaches the top of that 10-week trading band or near the 100% level, it tells us to expect a pullback to at least normal and vice versa to the downside. So while certainly not a guarantee, a reading of 87% suggests that the index is certainly moving further away from that rolling near-term average. And just to paint a little bit of perspective, we mentioned that 87% is the highest since January 17th. To get a bit more color, you can click the 87% itself, and it'll give you the historical weekly overbought, oversold reading for the market. And a recent addition that we would like to mention is you can actually see the intraday weekly overbought, oversold reading now once you click that 87%, as I've done so. And locate in the upper left-hand corner, we see an intraday weekly OBOS reading of over 92% now. So again, we see that 86.5 as of the last close, moving lower, and really notable are those extremes that we hit towards the end of March. Now, one thing to keep in mind about this indicator, specifically with the S&P 500 index, is that this is cap weighted, meaning those larger names are going to be carrying and or perhaps skewing this reading a bit. So a way that we can kind of circumvent that and to get a more pure overbought, oversold reading of the names in the index is we can look at an indicator on our platform called WDSPX, so weekly distribution for S&P 500. And what this is doing is this is taking the overbought reading or oversold reading for each security in the index and computing the average. Whereas the SPX overbought, oversold reading is the index itself. We are looking at the average reading for the securities in the index on an equal weighted basis. So as we see here, we're moving to the 50% threshold, meaning that the average member in the S&P 500 currently sports an overbought, oversold reading of about 50%. In this case, overbought about 50%. Now, 50%, you may think, well, that's much lower than the 87 or above 90 intraday, and that's certainly correct, but this 50% level is actually quite rare in and of itself. Our findings say that this is only the 10th time that this indicator has done so. And while there's certainly developing a case for that near-term overbought posture of the market, this doesn't necessarily mean that unfavorable returns are to come. In fact, some of the preliminary research we've seen is that returns really starting 3 to 6 months out are actually quite favorable when we have seen this WD-SPX indicator move above the 50% threshold. And I know a few months back, we also did a similar study with the SPX itself, that OBOS reading. So again, certainly some near-term cause, quantifiable, I'll say, from the overbought camp, but nothing that's screaming unfavorable or get out territory for the long run just yet. Is that right, Eric?
Yeah, it is, Will, and I think you hit on it, and a lot of good points there. And one thing I just want to maybe reiterate for those of you watching and listening at home, you know, in our research, we often do reference this OBOS reading and talk about whether a position is, you know, heavily overbought or oversold, you know, for potential mean reversion events, right? So if something's heavily overbought, has the potential to pull back to the middle of that trading band on a, you know, a near-term basis. But as you mentioned, Will, in a weak market, you can't have heavily overbought positions, right? So if the market is strong, you would expect to see positions moving higher and moving toward those heavily overbought readings on the OBOS perspective. And as you mentioned or alluded to, you know, our research has found for index constituents, mainly the S&P 500, you can really see, you know, long-term benefit to when these readings are elevated. So I would say it's more applicable to watch for heavily overbought when you're playing individual stocks for that potential mean reversion. Although, of course, we do mention it, it's just good to have the bit of nuance in there, I think, and you hit that right on the head. So with that, Will, you know, we're seeing overbought levels on the S&P 500. We're seeing continued strength there. When we look at the U.S. size and styles classifications found under asset class group scores, which is under asset allocation at the top of the site, this gives us a pretty holistic view of the domestic equity market by size and style category. And, you know, no stranger to the top of the rankings is the growth side of the style box, right? And we can see here that we have large cap growth leading all of the different size and style constituents with an average group score of 4.36. Keeping in mind that fund score reading for all of the funds included in that group range from 0 to 6, with 6 being the best. And, you know, again, as mentioned, with growth at the top of the categories, you know, that's definitely where the long-term strength is in the market. However, in recent trading sessions, and really in the past month or two, we've seen a little bit of a shift underneath the hood of the domestic equity universe. In fact, we've seen somewhat of a reversal, and some of the laggards are starting to pick up steam a little bit. And so in asset class group scores, if we're to pivot over and click the group score report, we're then able to open up the score direction for each group that's filtered on the last page. And rather than the default score direction, which is looking at a 6-month reading, we're able to then come in and say, okay, let's adjust this. And in this case, we're going to look at the last 30 days of score movement. And what we have here is an improvement across the board, right? We can visually see that all size and style categories are moving in a positive direction, which is great for overall breadth of the market. However, what's really notable here and what we want to bring your attention to is the fact that you've got small caps and mid caps really showing a lot of score improvement in that near term, right? And so Not necessarily quite there yet from an average fund score perspective. We still have a couple of those categories that are unfavorable overall. However, there are some like U.S. small cap growth that are just shy of that optimal 4.0 fund score level. And, that's going to give you some diversity in terms of where you can feel comfortable adding new money to the market. We've also seen small cap growth move up to the number 3 spot in the Dolly rankings for that longer term confirmation of strength. So these are all positive developments, Will, and I think it's really comforting to see that we don't just have the generals leading the battle anymore, right? As we often refer to in our research, those mega cap names that are really holding up the market, the Apples, the Microsofts, your FANG tech stock names. While those are, of course, an important staple to most investors' portfolios at this point, we do want some diversity of thought and some diversity of leadership here. So this is definitely positive. With that, how does this necessarily translate from the score view over into recent performance, Will?
Yeah, Eric, and I completely agree. And really just bluntly putting some performance behind it. Since the market bottom, we'll call on March 23rd, we've seen monumental returns from the indices listed here. As we have here sorted, we have the custom column, which is going to be from March 23rd through as of Friday. The mid-cap index, MID, is actually posting a return almost at 57% since that bottom, and then SML trailing behind at 51%. And the large, or those mega cap indexes being INDX, SPX, and the Dow Jones, those are all still producing returns north of 40%. So while that small and mid cap index groups or those constituents have significantly outperformed in the near term, they also had much larger drawdowns during the market sell-off. But nonetheless, a lot of strength across the board here that's actually translating to pure price performance in this particular instance. Eric, any thoughts you have on here before we hit a few of the individual ETFs that we're going to spotlight?
Yeah, I think the one thing to remember here, Will, is, as mentioned, large cap leadership has not changed hands by any means, right? We're still very bullish on large cap stocks, and the performance data that we have in front of us provides evidence for that, not only in the near term in terms of like a year-to-date view, but also a 1 year, 3 year, 5 year, and so on assessment of that index shows a lot of longer term leadership for the large cap constituents. But it is always good to see that improvement here in the mid and the small caps, and who knows, could be the beginning of a reversal. So something we'll have to monitor going forward.
Certainly, yeah. And maybe getting a bit more granular into some of the individual funds, starting with the mid-cap group as a whole, looking at IJH, the Ishares S&P Mid-Cap 400 Index Fund. Again, we note a fund score of 2.87, which is still below our generally acceptable score line of 3. And then our optimal score is going to be 4. So nonetheless, we're still below that kind of sought after 3 score line, but most notably, we see a really strong score direction of 2.44. And in addition to that, looking at the chart itself, recently re-entered a positive trend, giving 2 consecutive buy signals as of lately. We see that blue X noting intraday further advancement to the upside in the column with X's here. And all this coupled together actually gives us a similar look to what we started the conversation today with that weekly overbought, oversold discussion. In this case, also sporting about an 88% reading. So again, also moving to a bit elevated territory as well.
Excellent. Will, and if we look elsewhere at the small caps, using the iShares S&P Small Cap 600 Index Fund, ticker IJR, we see a really similar chart pattern, right? We're on 2 consecutive buy signals, a recent positive trend reversal, continuing higher. We still have overhead resistance at 76 on the chart here. And the fund score has a little bit left to be desired in terms of scoring below that acceptable 3 level, but a robust score direction of 2.21, similar to what we saw in the mid caps And as you mentioned there, showing an overbought reading that is a little bit frothy here, so something you maybe have to be considerate of. But for the most part, really showing absolute and near-term relative strength here for both mid-caps and small caps. So it's exactly what we want to see. Should give us a lot of confidence in this bull market, or this new bull market, I should say, as we continue through 2020, climbing the wall of worry that the market has presented to us, and that this current environment makes us go up against every day, right? And with that, we know this has been a challenging market for you and for your clients. So far we feel like we're getting through this and coming out the other end okay. But we understand that there are still a lot of questions. We're still in a period of heightened volatility, still in a period of rotation. So with that, if there's anything that we can do to help you, don't hesitate to give us a call. You can reach us at 804-320-8511 and simply ask for an analyst during business hours. Additionally, you can send us an email at dwa@dorseyright.com if you'd rather drop a line through that medium. But Will, with that, I think this is a great Monday for investors. Hopefully it's going to be a great month and a great rest of the year for investors as well. And for you all at home watching and listening, we thank you for your partnership, and we look forward to talking to you next week.